Hello from Sydney, Australia. I'm Natalie MacDonald and you're joining us for another Sydney Direct. Up next this week, I'm talking Asia Pacific stock markets with Chief Economist at Suncorp Group, Stephen Milch. Stephen, thank you so much for taking the time to chat with us today. Much appreciated.
Thank you.
Okay, so firstly, the ASX has been up this week on news of China's first rate cut in 2 years. This is after being down last week on a more Japan-centric week. Does this really highlight quite how sensitive the ASX is to regional developments?
It certainly does. It hasn't been a very convincing bounce, I have to say, this week. As you say, the Chinese central bank lowered interest rates on Friday. We did see a bounce yesterday in the market, quite a nice bounce, up 1%, but today it's given a lot of that back. And really over the last couple of weeks, yes, we had that news about Japan being technically back in recession, but really it's been a commodity story and falling iron ore prices in particular. And last week, some weaker Chinese data on manufacturing, on property. All of these things have really dragged down sentiment in the local market. And the funny thing is that our market alone has been falling. So we're down 3 or 4% over the last couple of weeks, while global markets have been rising. In fact, only last night, the S&P 500 at a new record high. So we've opened up this divergence in the last couple of weeks, and it's been quite noticeable, quite substantial.
Now, despite these growth figures that we saw out of Japan, stock investors haven't really been spooked on the Nikkei and really continue to back Abe, as it were. Does this match up with what you see in the future for Japan, economically speaking?
Yes and no. First of all, I think there's been a divergence or a split between real economic behaviour and investor behaviour. So, for instance, the US recovery has been good but not spectacular, but share returns there have been spectacular. In the last year or so, it's been similar in Japan. The economy has done okay, not brilliantly, but the share market has done fantastically. And we have been long the Japanese share market. We expected the weakening of the yen, the Abenomics that you mentioned. We think that's run its course to some extent, so only recently we closed down that long Nikkei position. Going forward, Japan probably still has some prospects. We hear about this commitment still to reform from Abe, even though he's called an election now. We're seeing increased equity allocations from their pension funds. We're seeing a weak yen. All of these things are positive. We just think for the moment maybe the market has run its course, maybe pauses for a little while, and we saw that technical recession, that weak GDP number, and that causes us just for the moment a degree of caution.
Bringing China into this picture as well then, Japan and China, how do you value their economies presently speaking?
I'm concerned about both. China is obviously more important, although Japan is still an important trading partner of Australia, an important consumer of coal and a producer of steel. They've got longer term structural issues. They've got poor demographics. They've got this massive debt, this massive public sector debt that the government is trying to grapple with. And we saw this consumption tax increase earlier in the year. Like the 1990s, it's basically killed the recovery. And now Abe has had to come out and say he's going to postpone the consumption tax increase. So a lot of problems, structural long-term problems in Japan. At least they have a committed leader. And Abenomics hopefully will deliver that structural reform, the needed improvement over the medium term. China's a bigger story, a different story. They're still growing at 7%, but that's lower than the 10% or the 9% we've become used to, as well as this property overhang and apartment prices are falling, a little bit of excessive credit growth. But again, I'm not too negative. There's a lot of negativity in the market about China and Chinese growth. I think perhaps it's excessive. The leadership are aware of it. We saw the rate cut on Friday night, and I think they've got the tools to make sure it's a soft landing, not a hard landing.
Which of these markets then do you see being the driving force then for this region? Or in that sense, does the power still lie with the US?
Well, the US, as I mentioned earlier, it's had a terrific run. The share market has performed phenomenally, really. Since 2011, it's been a strong run. I think valuations there are probably becoming a little bit stretched. So we come back to the region. Regional markets have been pretty good, not quite as strong as the US. We mentioned the Nikkei earlier, that's been quite strong. The Hang Seng, if we look at Hong Kong, it's been strong, not as strong as the Nikkei, but still quite positive. The one market that hasn't rallied substantially is China. And I think there are opportunities there for investors to have a look at China. They haven't participated in the global rally. Like I said, I think there might be some excessive pessimism there. And on that basis, it might offer an opportunity when other global markets are looking a little bit fully valued.
Stephen, thank you so much for taking the time to chat with us today. Thank you.
Pleasure, thank you.
Sadly, that is all we've got time for, but our many thanks there to Stephen for his comments, and thank you viewers very much for watching. Until next time, goodbye.